Howdy, Jacob here. Today we're looking at Southwestern Energy Company in the oil, gas, and consumable fuels industry. 8.4 billion market cap on 12 billion enterprise value. Corporate in 1929. It's been around for a minute. We're almost looking at a century-old company right here. Pretty crazy. Growth has crazy growth in 2022. There was some wild stuff going on in 2021 as well, but I think that was pretty heavily due to the price of oil changing so much due to inflation and everything. So I'm definitely going to be using averages here based on the immense volatility we're seeing in pretty much every metric. Return on invested capital recently has been very grand, but is fluctuates like the other parts of the business. 21 million cash on hand with 3.9 billion long-term debt. I'm concerned by that. That is a bit alarming. To put it into a more basic perspective, I try to do an analogy that kind of makes sense on a more granular level. So let's say you have $21,000 cash on hand and a $4 million home. I mean, that's not, the home is going to be, you get a 15, 30-year mortgage. This long-term debt is likely due in 2 to 10 years or so. So it's due quite a bit sooner, but I definitely prefer a bit more cash on hand than that, especially with the amount of debt that they have. But let's see their cash flow. Let's see if they're producing quite a bit. So cash flow shows negative over here, 500 million roughly in free cash flow. They're using that to pay down debt. So they are thinking about the debt at least. That's good. It's not like they're just issuing it and keep issuing it like some of the energy companies that I've seen. But um, yeah, there's no other use of cash flow at least in the last 2 years besides paying down debt and I guess a little bit of share repurchases, but not much. So let's go to making some assumptions here. It's an interesting business, not one that screams sexy to me, but every positive earning business can absolutely have a price point. And so let's see what we think this will be worth. I think that we'll probably do the basic 3 and 13. I usually do 3% revenue growth, 13 for P and price free cash flow for pretty volatile companies that I might not, have a best understanding of what's going to happen. I'll just be like 3% in line with inflation, 13 for a little bit conservative P and price to free cash flow based on market at the end of 7 years. And then for margins, let's just do exactly what this average is. 0% share change. I mean, it's not the craziest analysis with assumptions and everything, but to me, it doesn't scream deal at this price point, and so I would wait a bit more for it to fall to. I want it yelling. I want it yelling from the streets, the mountaintops that this is the most obvious thing possible, and right now it just doesn't seem to be that case for me. So I hope you enjoy the video, and I hope you have a great rest of your day. Thank you.